Thank you very much. Welcome back, everyone. May I have your attention, please? Thank you. I hope you had a good lunch break and maybe got a chance, or it's quite evident that you got a chance to continue the exchange that we were having here before the break. And I'm glad to see that the break was so successful in promoting some networking. So we were speaking before lunch about the push towards supervisory convergence. And it is, of course, one of the trends that is fostering innovation in this area. But there are other underlying trends that are at work as well, which are transforming both strategies and business models. And I refer, of course, to technological developments, the rise of finnovation, but also to the ongoing low interest rate environment and the drive that that creates to, as we were discussing with Chairman Bernardino, to search for yield. Our keynote speaker will address innovation along all of these dimensions. And because we were talking about convergence, you might say that he is the incarnation of a certain form of European convergence. He is the governor of the Banque de France, but his roots go all the way to Germany's Saarland. He's the former CEO of CTLM and the former chief operating officer of BNP Paribas, and he has also held various posts in French ministerial cabinets. It is a great honor to have with us today Francois Villeroy de Galhau. Please, the floor is yours.
Thank you, Melinda. Good afternoon, bonjour, guten Tag zu allen. Dear Gabrielle, ladies and gentlemen, dear friend. It's really my pleasure to be here in Frankfurt today for this 7th already annual EIOPA conference. Thank you for inviting me. But I must say that I feel a bit at home here in Frankfurt, since we are not far away from the ECB building, where I take part in the meetings of the Governing Council at least every 2 weeks, and still this afternoon. But today I will not speak as governor or member of the Governing Council. I will speak in my capacity as president of the French Supervisory Authority, the ACPR, Autorité de Contrôle Prudentiel et de Résolution, which belongs and is proud to belong to the Board of Supervisors of EIOPA, and which is in charge of the supervision of both insurance companies and banks in France. This is for me an important responsibility, as the French insurance market is the second largest in the European Union, just behind the United Kingdom, which being still in the European Union is still the first market, for a while, with an aggregated balance sheet of approximately 2,600 billion euros for French insurers. Given that I'm speaking just after your lunch, but before the panel dedicated to innovation, I will take the opportunity to focus on 3 kinds of innovation, which in my view can lead us not only to reload, but to rethink insurance and pensions, institutional innovation, economic innovation, and technological innovation. Let me start with institutional innovation. I would like, first of all, very sincerely, Gabrielle, to pay tribute to EIOPA, which has done remarkable work to promote sound and consistent European regulation and harmonize supervisory practices within the EU since you were established in January 2011. The creation of EIOPA followed the Larosière report, and I believe that it has been a clear success. In a context of increasing financial market integration, EIOPA has contributed to ensuring a true level playing field for all actors in the insurance and occupational pension sector at the EU level, in coordination with national authorities and with the other European supervisory authorities. This well-balanced supervisory framework helps us deal with the institutional innovation that we are starting to see as a consequence, obviously, of the Brexit vote. Let me say some words about this part of the institutional innovation. Some British entities are indeed considering the possibility of simply setting up empty shells corporations in the European Union. Mere company nameplates, be they in copper or in other metal, while keeping their resources in the United Kingdom. I fully agree with EIOPA that vigilance is called for in this respect. Moreover, Brexit brings with it certain risks. I am thinking in particular of the European policy holders who took out insurance directly with British undertakings and who should continue to benefit from the same protection. EIOPA, in liaison with the British authority, has rightly made British insurance undertaking aware of the necessity to draw up contingency plans to deal with Brexit, irrespective of the fact that negotiations are still underway. This is particularly important to ensure that Brexit takes place as smoothly as possible with limited effect for policy holders. I stress this very practical point because it's often a bit forgotten in the Brexit discussions, but it's very important that we stick to it. Beyond Brexit and for the future, however, it is worth considering the need to adjust the European institutional framework so that it remains as efficient as possible. The review of the ESAs, as proposed by the Commission, should prompt us to strengthen EIOPA missions. There are two areas in particular where enhanced convergence is needed, so that all European consumers are protected wherever the insurer is located in the EU: construction and medical liability insurance. EIOPA has already launched cooperation platforms in order to facilitate information exchanges regarding construction liability insurance. We are strongly in favor not only of pursuing these initiatives, but also of adopting measures to harmonize supervisory practices in this regard. At the same time, we should maintain a clear distinction between the day-to-day supervision entrusted to national competent authorities, NCA, and the regulatory harmonization role that has to be played by EIOPA. In line with this principle, the validation of internal models, for instance, should preferably remain, in our eyes, the responsibility of the NCA in order to reflect the close link between these decisions on internal models and the ongoing dialogue that takes place between the insurer and its national supervisor. EIOPA, for its part, could concentrate more efficiently in the essential task of enhancing the harmonization between national practices. In addition to these desirable adjustments of the European institutional framework, there is a need to make concrete progress towards a European resolution mechanism. And this is my third point about institutional innovation. It would provide more adequate tools to limit the impact of an insurer failure and increase trust and confidence. France has been working along these lines at national level, and such a mechanism will be in place in my country before next December. So it's a question of weeks. The French resolution insurance regime requires insurers of a certain size to set up preventive recovery plans, which will form the basis for preventive resolution plans. Let me now turn to my second point, economic innovation. As Europe's economy is close, fortunately, to what we could call the technology frontier, businesses need to innovate more. As such, they need to be able to take more risk, which requires more equity financing over the long term rather than debt financing. This is a very basic, almost simplistic economic truth, but it is of utmost importance for our debate, for our audience, and for Europe. Growth requires innovation, and innovation requires more equity financing. And in this regard, the euro area is unfortunately seriously lagging behind. I quote you figures which are not very well known, but which are, for me, the real financial transatlantic gap. Equity capital amounted to only 68% of GDP at end 2016 in the euro area, compared with 128%, almost double, in the United States. And yet, resources are abundant. The excess savings in the euro area relative to investment is around 350 billion euros each year, 3% of GDP. And as you know, this is exactly the size of the external surpluses of the Eurozone, and we all know that there is a tautology, an identity between external surpluses and excess savings. It is therefore crucial for the euro area's economy to better steer these savings towards productive investment across borders, notably by shoring up, as I said, equity, which is the key to an innovation economy. Startups are well aware of this, and probably we are now more successful in Europe financing startups. But our European scale-ups, mid-caps, and SMEs also need greater access to equity leverage. And here, the insurance sector has a key role to play, since it is the largest institutional investor in the euro area, with total assets of close to 7,800 billion euro in the second quarter of 2017. In practice, what is the way forward? A large part of the solution lies at the European level. The efforts so far are going in the right direction, but work should now be accelerated on what I call a financing union for investment and innovation. Let me elaborate somewhat about that, and you will see that it is a direct topic for you interest. This financing union is the microeconomic accelerator, beside macroeconomic accelerators, the microeconomic accelerator that we need to make concrete progress towards a genuine economic union in the euro area, and to cover, you see it with this green circle, the significant, the obvious investment needs we have, at least in three fields: digitalization, SME scaling up, as I mentioned, inequity, and energy transition. The building blocks for such a European Union for investment and innovation already exist, but they are separated. You have the Capital Markets Union, which promotes the diversification of private financing. You have, in another European city, Luxembourg, the Juncker Investment Plan, which channels a mix of public and private investment towards the real economy. And you have here in Frankfurt the Banking Union, which addresses persistent financial fragmentation. These initiatives obviously lack the unified governance of a financing union, which would help circumvent bureaucratic barriers, and yes, there are bureaucratic barriers, and to foster synergies. But in addition, for this financing union to be effective, progress is still needed in four key areas. First, providing incentives for cross-border investments, mainly in equity, and this is an issue you know very well, through, to quote only 3 examples, accounting, taxes, and insolvency laws. Second, developing pan-European investment vehicles like European venture capital funds and long-term saving products. I will focus on this area of progress, which is of particular interest for the insurance sector. Third, completing the banking union. And fourth, controlling financial activities and risk that are of vital importance for the euro area, such as super systemic CCPs. In this context, insurers have an essential role to play by taking the lead on new forms of life insurance that are compatible with the low interest rates environment, with the euro area's need for equity financing, and compatible also with the expectations of euro area households. Old age provision is now the second most important motive for saving. This means insurers should pursue reflections to develop new long-term savings products, probably derivated from the present life insurance. These products should offer over time the higher returns provided by equity, and they can be less liquid than today, while also featuring a form of capital protection, which is a very wide expectation of European savers. Less liquidity, but capital protection in the long run. It remains crucial that product innovation continues, however, to be carried out carefully, without undermining the protection of policyholders. In this respect, can I have a slight word of attention to be paid to the Pan-European Personal Pension Product, PEP. The PEP is an avenue to develop pan-European products and responds to the need for insurers to break away from the dual capital liquidity guarantee. Yet, it also raises some concerns. Information on the risks incurred under the different types of guarantee may not be clear enough to consumers. And in addition, the guarantee may ultimately depend on the financial company that is offering the PEP, as there is a difference, for instance, between insurance companies abiding by Solvency II and asset managers, which have lower capital requirements. This brings me, and it's another issue, sorry, I will come back. This brings me to another issue on economic innovation, which is the issue of regulation. Here too, insurers have to play their part by actively contributing to the review of the Solvency II directive's new regulatory framework. Solvency II is a very often debated issue. Gabrielle, myself, and all of you know it. Let me say clearly that in many respects, Solvency II represents a very significant step forward for the insurance sector. But this does not mean, obviously, that it is perfect. We must analyze its impacts closely, particularly its effect on investment behavior. Progress has already been made on the financing of infrastructure projects and businesses, thanks to 2 amendments that came into effect in April 16 and September 17, respectively. They are most welcome. But more generally, the reviews of the standard formula and long-term guarantee package measures planned for 2018 and above all 2020 are important opportunities to make essential improvements. The work is already underway, and I welcome the proposal published by EIOPA early this November to reduce the capital requirements for unrated debts and unlisted equities under certain conditions. This revision work will be difficult. It will be important, so let us start thinking and working now already. The Commission specifically requested that it look at those unlisted or unrated investments. But we may want to look more widely and encompass other types of long-term investments with innovative proposals for amending Solvency II, with the aim of striking the right balance between effective supervision and the financing of the real economy. It is now up to the industry to seize this opportunity to share its views and experience. Up to you. Looking at the overall picture of solvency calculation, the correlation between asset classes, for example, to fully recognize the benefits of the diversification of long-term investments could be an innovative way forward. And I understand that, Gabrielle, you also shared some interesting reflections on this topic this morning. Again, it's a very important review. Let us start working now and in an open way. Let me, to conclude, elaborate on my third and last point, technological innovation. The digital revolution is creating many opportunities for both financial players and consumers, including an increasing number of more accessible financial services and more complete customer satisfaction. In France, the ACPR is mobilized to support innovation, as demonstrated by the creation of the FinTech Innovation Unit and the FinTech Forum with the French Financial Markets Authority, the AMF. Within this FinTech Forum, we work closely with other public authorities to promote the development of FinTechs and InsurTechs in Paris. A year ago, to give you one example, the ACPR authorized the first fully digital insurance company in the health sector, the InsurTech Alan. But beyond FinTechs, and this is also important, in the case of existing insurers, the digital revolution starts with a complete overhaul of customer relationships and user habits. But it goes further than that. In the digital disruption, the insurance sector can bring stability and protection. And this has always been the raison d'être of insurance. I would like to underline briefly two topics that I think are essential in that field: cyber insurance and big data. Coverage against cyber risk, first, is a very real concern that affects all companies, both small and large, as cyber attacks are becoming increasingly frequent and costly. The figures we have, and it's not by chance, come mainly from insurance companies. And I will quote you a figure coming from Lloyd's and Science. The estimate is last year, in 2016, cyber attacks were estimated to cost businesses around $450 billion a year at the global level. But despite these threats, the cyber insurance market is still underdeveloped. Insurers can and should take inspiration from their own experience in tackling cyber risk and use it to develop a more mature European cyber insurance offering. The second subject I would like to allude to is personal data and big data. Naturally, the spread of connected objects that is triggering an exponential rise in the amount of data available on insurance policy holders represent an opportunity for the business of insurance, which consists precisely in collecting and exploiting data in order to quantify and put a price on risk. Nonetheless, insurers should take a responsible approach. We need to strike the right balance between segmentation, made possible by data, and mutualization, that is to say, the sharing of risk between policy holders. And this balance between segmentation and mutualization will be probably one of the trickiest challenges we will have together in the future. The basic principles of solidarity and risk pooling that are intrinsic to insurance are at stake, and we must not lose sight of our collective values regarding individuals' right privacy. To conclude, I wish to stress that all these three innovations obviously require creativity on the part of both supervisors and insurers. There is a good economic author in difficult times who is John Maynard Keynes. As you know, he profoundly renewed economic thinking. And he was well aware of this need to think out of the box. He wrote in the preface of the General Theory, I quote, "The difficulty lies not in the new ideas, but in escaping from the old ones, which ramify for those brought up, as most of us have been, into every corner of our minds." Unquote. I find it a nice sentence. And in this respect, as insurers, it's up to you to shape the insurance of the future. And as I said, a lot is being done and a lot has to be done. And it's for us, as supervisors, to demonstrate enough flexibility so as to foster your innovations while ensuring that the key principles that I mentioned earlier are respected. I am very happy that this very issue will be developed in the next panel discussion. I wish you a fruitful reflection while I will be in my ECB tower on the 41st floor. But I have spies in the room, so fortunately I will learn more about your reflection, and I thank you for your attention.